All right, so I want to introduce you to the concept of the weighted average, the weighted average cost of capital. The weighted average cost of capital, usually you call it WACC. Yeah, I see most of the times abbreviated as WACC. Okay, the weighted average cost of capital. So just to give you a short background around this topic. So what is there is that, you know, when a firm, remember when I was introducing financial management, I said as a financial manager of a company, you get to decide when, especially when an investment project comes in, you want to decide the capital, that the money that you're going to use investing in that particular project. Okay, so you undertake a lot of projects, then the money that you use to fund those projects comes from different from two different sources. So what usually happens is that there are mainly two types of or two main components in the capital that you have. Yeah, the money that you have to carry out the day-to-day transactions is called the capital. That's what we said last time. So now, the capital has got the two main components. It has got the debt. It also has got the equity. Okay, it has got the debt and the equity. So on the debt part, this is where you decide now as a firm. You say, okay, to fund these projects, what we are going to do, we're going to issue out the bonds. For example, the bonds, we're going to issue out the debentures. Okay, we're going to borrow money from the people using debt. That is to say, when you get money from the people, maybe you allow people to buy preference shares, or you issue out the corporate bonds. What happens is that when people invest that money, they are expected to receive something in return in terms of the interest. Okay, so the amount of money that you need to pay back these guys who have loaned you, in short, you've gotten a loan from the public, especially when you issue bonds. That cost you have to pay, the interest on top, is what is called the cost of debt. Okay, is what is called the cost of debt. Cost of debt. Then at the same time on equity, if you want to raise the money via equity, what usually happens is that you issue out ordinary shares. Okay, ordinary shares. Now, with ordinary shares, the way how they work, yeah, when you issue out the ordinary shares, for example, here in Zambia on Luse, what happens is that the people who will be willing to buy shares, that is buying part of your company. For example, this time around, if you go on Luse, you find a lot of public limited companies, they listed their shares. They have their share, they issued the shares. For example, in ShopRite, this time around as I'm talking, a share is 64 kwacha. So if you go there, you want to buy shares in ShopRite, it's just that easy. You get your money and then buy the shares. One share, 64 kwacha. Then you can multiply. If you want 100 shares, that is 6,400 kwacha. Yeah, just like that. You buy the shares. Now, when you buy the shares, what happens is that you are part of especially the ordinary shares, you are part of the owners of that company. Being part of the owners of that company, you share both in profit and loss that they make. So even if the company has made losses, okay, even if the company has made losses, if the company has made losses, you are not going to receive anything. You want to receive dividends, right? In return, you have made loss as a company. But if you have got other shares, for example, the preference shares, or you have got the other form of capital, you give money maybe to the company form, you get the ventures, the bonds. Even if these guys have made a loss, they are supposed to pay you your money. okay, because it's a debt. The company got a debt from you. But if you bought the preference, the ordinary shares, when they make a loss, they just come, no, we made a loss. And you keep quiet. Yeah, you made a loss because you agree to be part of the owners. You're sharing both in profits and losses of the company. So that's what happens. So when you are deciding on the sources of finance, you ask yourself, are we going to use a debt? A debt simply means you have to pay back even if you have not made profit or anything. That's what debt means. Then for equity, you are going to issue ordinary shares, whereby if you have not made a profit, no one will come to you and start saying, give us something when you have not made a profit. You just simply report, we haven't made a profit, and you keep quiet. Yeah, just like that. So that is how these are the two main sources of what? These are the two main components of the working capital. Yeah. Yeah, so now the cost of equity, I've talked about the cost of debt. The cost of equity simply means that when you have bought shares, the ordinary shares from a company, right? You have bought ordinary shares from a company. As you buy the ordinary shares from the company, that company that you have bought shares in, it is risky, okay? It is risky, it has got some risk. You have an opportunity cost. That money you have invested in that company, maybe you would have gotten it and buy treasury bills from the government. The treasury bills from the government, or buy the government bonds. You know, the treasury bills from the government, these are securities that are less than 1 year. Okay, you can buy these securities less than 1 year, 3 months, 6 months, 9 months, just like that. Less than 1 year. Okay, when you buy the treasury bills, the government can never default, especially it cannot fail to pay back all the debts that are gotten on what? That are denoted in the local currency. Because if anything goes wrong, they have the power to issue out a loan, actually. They can just issue out a loan. And as they issue out a loan, they can print out money. Yeah, that's what I mean. The government can print out money, especially via the central bank. They print out money and they give you your money. So they can never fail to pay back, which means it is not risky. It's nearly less risky to invest in government because it will never default. But when you invest in these other companies, there is a risk. There is a risk of them defaulting. There is that probability that they will come and tell you that, no, we have failed to pay back now these shares. This time around, we have not made a profit. You know, they can't promise to give you the money at the exact time because there are those changes that happens around. So it is actually risky to invest in these other companies, but you just have to incur the risk anyways. So now, when you say equity risk, equity costs, the cost of equity simply means the opportunity costs, okay? The opportunity cost, which means the sacrifice that you make by investing in that particular company instead of investing maybe in government bonds or treasury bills that are less risk. So that is what usually happens. Okay, so far, do I have any question from anyone? I was just introducing you to the whole idea so that at least you have the picture in mind. Any question before we give you we start solving questions? Am I logged out?
No, you are there, sir.
Okay, do people have any questions? No one has a question. Okay, thank you very much. So the 4 components of the weighted cost of capital are the following. Number 1, there is debt, how much debt you have. In the capital structure, you have your capital, you call it, maybe you have 5 million. Out of that 5 million, how much of it is a debt and how much of it is equity? Okay. Then at the same time, you have the cost of debt. You also have the cost of what? Equity, in terms of the percentages. Okay, those are rates, they are interest rates that you follow through. Okay, so the formula is given as follows. WACC, which is weighted the average cost of capital, it is equal to the cost of equity That should be multiplied by the value of equity divided by the value of equity plus the value of debt, you close, plus the cost of what? The cost of debt before taxing, 1 minus tax, close that, you multiply by the value of debt over the sum of the value of equity plus the value of what? Of debt. Okay? So this is what is actually there. This is the simple top. This is the simple, what's this? Simple version of the WACC, the weighted average. Now, what are these? What do these writings denote? Number one, KE is cost of equity. Cost of what? Of equity. I told you that equity is not free. It has got some cost. There is that opportunity cost, because the investors, when they buy shares in you, since it is risky to invest in your what? In your firm, they will require some risky premium. Okay, they require some risky premium. There is that premium that they require. So that risky premium that they require represents the opportunity cost. So that's the cost of equity that you actually want, because that's what usually happens. I'll talk about these things in detail later. VE, which is the value of the market value of what? Equity. All right. This is the market value of equity, VE. And VD, V lower D, it's actually the market value of what? Of debt. Okay. How much debt do you have? And which one has rent? Okay. A KD, this one is the cost of debt. This is the cost of debt actually before taxes, whereas T is taxes, it's representing the corporate taxes. So that's what usually happens. This is the simplest version of WACC. That is the version that does not have the preference shares, okay? Because if you are to introduce the preference shares, actually we just add down here in the denominator. This is the denominator I'm talking about. The denominator will be VE plus V what? VD plus VP. That is where VE is value of equity, VD is value of debt, and the value of preference shares. Then you will add to the last part the value of what? The value of preference shares, and multiply by the cost of what? The cost of preference shares. The preference shares, they also have cost, but most of the questions that you have, they don't have this version. Oh, this is the highest version, the full version, when you introduce the preference shares. So it is just that. So in the meantime, we can simplify the conversation by looking at what is most of the times asked, and this is what is most of the times examined, what I have just given you. So this is the formula that you use actually. So you multiply the cost of equity, that will be given in the question. We'll show you, if it's not given, we'll show you how to calculate it. Then you also multiply by the weight. This one is actually the weight of equity. The whole lot of this, it is called the weight of equity. Why is it called the weight of equity? We have expressed the equity, the value of equity as a what? As a percentage, as a fraction of the total capital. Okay. Out of the total capital that we have, how much of it is equity? Then this side we have the weight of what? This is the weight of what? The weight of debt. That is out of the total capital we have, how much of it is debt? And that is how you get to decide around these issues. So about the formula, do I have any question? Hello? Have you all understood the question? So that we show you an example on how to go about it.
Sir.
Madam.
On the formula. class soap, is it VD over VE plus VT, or is that G?
It's VD. It's the over VE plus VD, where VD is the value of debt, right?
Yes.
Yes. This is what is called the WACC, the weighted average cost of capital. So when we say we are weighting it, meaning we are looking at, we are considering, we're also trying to consider the way how the cost structure is arranged, okay? In terms of how much debt do we have, how much equity do we have? If you have more debt, then we have to make decisions. Okay, we have to reduce the debt, okay? So when you see that the cost is too much, then we have to maybe restructure, okay? Restructure the structure of cost of capital that we have. We can restructure it, and we can increase more of the shares and reduce more of debt. Just make decisions around that in management. Clear? All right. There's no one to pick up, and it's like Maureen is logged out. Okay, so anyone can keep on asking answer so that I hear if people are following. Is the star logged out?
You're still logged in, sir. We are listening. We're following.
Okay, thank you. Thank you very much. So this is the formula. Let's understand the formula very well, and then everything will be easy around the cost of capital. Very easy and very straightforward. Let's have the example. Let's just have an example. An example shall do better. So
interest.
It's like just a minute.
Hello?
Yes, madam. Okay.
Yes, sir. Hello?
Hey, you were logged out. So we were trying to find out if you're in. Yes, madam.
Network, is it just me or it's everyone? Network seems to be very bad.
Is it from my end? Hello, can people confirm if
yeah, I'm saying yeah,
hello?
maybe someone else should confirm, because with me here it's very bad.
No, let me just hear the confirmation. Is it from my end? That network pressure, is it from my end that you can't hear me? Or if you can? Can I hear someone confirming if you cannot hear me? Hello. People are not confirming.
Can hear you now. I can hear you now, though network is not stable.
I can hear you from my end. Okay.
Okay.
All right, it's okay. Let's have the example so that we cement the understanding. Let's have company XZ Limited that has computed its cost of equity and before tax cost of debt as 16% and 11% respectively. The statement means that the cost of equity is what? 16%. So the cost of equity has been given as 16%, and the cost of what? And the cost of debt before tax is what? 11%. Then the weighted market value of equity is 75%, and that of debt is what? 25%. Then the corporate tax applicable is 30% per year. Calculate the WACC. calculate the weighted average cost of capital for XZ Limited. Have we gotten the question? We show you what is there now.
Yes.
Okay, so what is there is just as I said, for you to calculate WACC, just know that you need the cost of equity, you need the cost of debt, right? You also need the weighted market value of equity and the weighted market value of what? Of debt plus the corporate taxes, if at all you have any. Then you can easily calculate. So let's go and start calculating in the formula. So what do we have as the cost of, in decimals, of course, the cost of equity? The cost of equity, let me just erase here so that you start right. What is the cost of equity? What did you say the cost of equity is? Oh, we didn't see the question. The cost of equity, what is the cost of equity? 16%, right? The cost of equity is 0.16, 16%. So we write 16%, that is the cost of what? The cost of equity, 16%, which is 0.16, multiplied by, now this part, value of equity expressed as the total sum of the value of equity plus the value of debt is what is called the weight, okay? The market weight of equity. Is that clear? So when they say the market weight of equity, it simply means they're simply referring to this expression. Sorry, VE over what? Over VE plus VD. This whole expression that I've just written represents the market weight of what? Of equity. Whereas this one is for the market weight of debt, like you have weighted it. I've expressed it as a fraction, okay? And multiplied by 100 to make a percentage. Is that clear?
No, sir, just say again. I think I'm getting a bit confused.
Okay, you will not get confused. So I'm saying this one that I have circled here, this represents the market weight. It's the market weight of what? Of equity, okay? This is the market weight of equity, this whole expression. So if in your question, they have already mentioned that the market weight of equity is this much, it means on this part where there is this, you just see, replace it by putting that value that they have said it is the market weight of equity. Is that clear? Did you get that one? Hello, is the questionnaire fine with the explanation?
Yes, sir.
Okay. Yes, sir. So the later one is the market weight of debt. So what are we given in the question as the market weight of equity? 75%, isn't it? The weight market value is 75% equity. So 75%, which is 0.75. So here we are putting 0.75 as the market weight of equity. Then we have the cost of what? Of debt. The cost of debt before what? Before tax. So plus the cost of debt before tax. What is the cost of debt before tax? Hello?
11%
What is?
for 0.1.
It is 11%, right? What is tax?
30%.
Sorry?
What's the question again?
Oh. Yeah. Hello. I was asking, what is the cost of what? Of debt before tax? It's 11%. Sorry?
11%.
11%, isn't it? It is the cost of debt before what? Before tax, 11%. Then the tax is 30%, which is 0.3. So here on the cost of debt, you write 0.11, that is 11. That's the cost of debt before tax. 1 minus the tax. The tax is 0.30, right? That's 30%. Okay, that is the 30%. That is 30%. 30% is same as 0.30. 11% cost of debt before tax. Then what is the weight of debt? The market weight of debt, which is representing this whole expression afterwards, BD over VE plus BD. That is the market weight of debt. So what is the market weight of debt? According to the question we have, what is the market weight of debt? Hello?
25%.
25%, 0.25. Thank you. So you have 0.25, 25%. And so we can now calculate. What is 0.16 times 0.75? We calculate this side. 0.16 times 0.75. Calculator do well.
0.16 times 0.75 is equals to 0.12.
Okay, it is 0.12 plus, what is 0.11 times 0.70? Okay, we know that 1 minus 0.30 is 0.70, isn't it? That we know, that's the expression in here. So here there is just 0.70. Let's multiply and get one figure here. We see what we have. What do we get? 0.11 times 0.70.
0.077.
0.077. Are we all finding the same? Do I have someone finding the same?
Yes.
Okay, so multiply that by 0.25. Multiply that by 0.25.
0.0129. Oh, 0.0192.
Okay, so 0.12 plus 0. What?
0.0192.
192.25, which will be 3, right?
Yes, I'm sorry.
Then you add the two. What is the cost of equity? What is the, not cost of equity, what is the cost of capital? Just add the two.
0.139.
0.139. Okay. When you multiply, this is when you multiply this by 100 so that we can express it as a percentage. Kyle, it is the interest rate. So it will give us 13.9, right? 13.9 something percent.
13.9.
As the weighted average cost of what? Capital. That is how we find WACC in this same example. Any question on how to find WACC using the first example? We'll still do another example, even as many examples as we can. Ma?
I want to know
At first, you said this expression VE over VE plus VD is market weight of equity.
Yes.
The whole expression is market weight
Yes.
of equity. Then
Yes.
what about the VD over VE plus VD? What expression? What do you call
the market weight of debt?
Oh, thank you.
Okay. Any other question? Okay. Now that there is no question, we can do another example. We can actually do another example. Before we do another example, let me just erase here. Then you can even do another example just to cement your understanding. And you know, when you learn, you even see that the questions in your assignments are very easy and very straightforward. You can even see that. But don't worry, it shall be well. We are always there for you. We have been there, we'll be there. So now, we go to, which one is the second example? Example number 2. Okay, let's have the second example. Example number 2. Remember, whenever you're calculating the cost of the WACC, you are looking for what? Cost of equity, the value, the market value of equity, the weighted market value of equity, of course. Then you're also looking at the weighted market value of debt plus the cost of what? Debt, and the taxes, if at all you have corporate taxes in there. So let's look at this example, which is a little bit complex, just a bit. Company VDX has 200,000 shares that are currently trading at 2 kwacha and 15 ngwe per share, and a 10% irredeemable debenture of 150,000. So the current value of the debt is 95 kwacha per 100 kwacha, which is same as 0.95, right? 0.95 nominal value. So the cost of equity is 15%. At least we are like the cost of equity is already given as 15%, and the applicable corporate tax is 30%. So can we calculate the weighted average cost of capital work? Very easy, right? So let's go and start identifying these numbers. So we will start with the value of debt, right? The value of debt. But to start with the first, before we calculate the value of debt, since we already have the cost of equity, we can calculate the total market share of the total market share of equity, right? How much equity do we have, which are shares? We have 200,000 shares times the 2 kwacha and 15 ngwe. We get how much value we have that belongs to equity. So you multiply 200,000 times 2.5. That will give us the VE, right? VE is equal to 2,000 shares times the price per share, which is 2 kwacha and 15 ngwe. So what is the value of equity?
$500,000.
500,000. 500,000. Are we all finding the same?
Sir, sorry, I think I've got a problem with the network. It keeps on skipping. So maybe you can say again, I mean, this far where you've reached.
Okay, I was saying we are looking for the value of equity. How much equity do we have? There is a question here. It says that this company has 200,000 shares that are currently trading at 2 kwacha and 15 ngwe per share, okay? And a 10% irredeemable debenture of 150,000. So the current value of the debt is actually the current value of the debt. So the debt is 95 out of 100 by the nominal value, okay, multiplied by the nominal value. Yeah. So the cost of equity at the same time is 15% and the tax is 30%. So what is the WACC? The weighted average cost of capital. So to start with, I said we are calculating for VE, which is the value of equity, right? So to know the value of equity, we just multiply the number of ordinary shares times the price per share. The price per share is 2.15 where multiplied by 200,000 shares. So we found 500,000 as the market value. Question. Is that clear?
Yes.
Okay. We have seen the VE. We have seen the VE. The KE, which is the cost of equity, is already given as 15%. The question said the 15%, which is 0.15. We need the cost of debt. The cost of debt, yeah, the cost of debt minus corporate taxes. But you see, the debt that we have actually is an irredeemable debenture. So there is another formula that you use for you to calculate the cost of debt for the debt that is not redeemable. Okay, so the formula to find the cost of debt that is not redeemable, it's given as follows. The cost of debt for an irredeemable debenture is the interest that you get from the debenture, 1 minus taxes, divided by the market value, the current market value of the debt, V of debt, which is the market value of the current market value of debt. When you divide that, you find the cost of debt. And we can move on and find what is the interest. So the interest is found by multiplying. We know that the debenture that we have, the debt itself, it is 150, right? So get the 10%, that is the interest. 10% of 150, that's the interest. So what is the 10% of 150?
It's 15.
It is 15,000, isn't it? That is the interest. Okay. So the interest is 15,000. So we will write 15,000 times 1 minus tax 0.30. And we know that tax 1 minus 0.30 is same as 0.70, right? 1 minus 30 is same as 0.70 divided by the market value of debt. Now, what are we given as the market value of the debt in the question? The current value, market value of the debt is 95 out of 100 times the nominal value, okay? Times the nominal value of the debt. The debt is 150,000. So you say 95%, which is 95 over 100. 95 quarter over 100 quarter times what? Times 150,000, right? Which is same as 0.95 times 150, right? 0.95 times 150. And what do you find? We want to get the market value of debt. They have said, the question has said that the market value of debt is given as what? 95 per 100 quarter nominal of the nominal value. The nominal value of the irredeemable debenture, which is the debt, is 150,000. So what amount do we find? 95 over 100 times 150,000. What is the value? in the denominator here. It's the market value of the debt. How much is it? Just say 0.95 times the 150,000.
It's 142,500.
142,500 kwacha. So this is the market value of the debt. So what is the cost of debt now? You can easily find the cost of debt. What's the cost of debt? You say 15,000 times 0.70. The answer divided by 142,500. That will give us the cost of debt. What is the cost of debt in percentages? Hello? What is the cost of debt in percentages? You simply say 150,000 multiplied by what? 0.70. You close that. Equal to 10. It will be equal to 10,500 divided by 142,500. What is the cost of debt?
It's 0.073.
Okay. 368, right? Which we can write as, we can simply write it as the cost of debt as the 7.37%. As the cost of what? Of debt. So we have found the cost of debt after taxes, which is this part. We're also given this one. We need to find this one. We can just calculate the value of equity divided by the value of equity plus the value of debt. We already have those figures. You can just calculate. Let's find the value. The value of equity we said is 500,000, right? That's what he said, VE. Our VE is 500,000 divided by 500,000 plus the value of debt you said is 142,500. You said that's the market value. So what do we find? What do we find as this is now the weight, the market weight of the value of equity? What do you get?
Sorry, sir, excuse me. I don't understand what we're calculating for. Can you please repeat it again?
Sorry, we want to get this part which is circled in red, okay? Which is VE, the value of equity, divided by the value of equity plus the value of debt. That's the part we are finding. Since we already have the cost of equity, 15%, 0.15 is given in the question. Does that help?
Yes, thank you.
Okay. So what do we find as the weight?
It's 0.7782.
0.7782. Are we all finding the same?
Yes.
That's a weight, right? So you can just write it as a decimal 0. What? 7 what? 78, isn't it? 2 decimal places. 0.78. As the weight, this is now the weight of equity. Let's find the weight of debt. The weight of debt will just be almost same as the one that we have just found. Just change here on top, we put the debt. The value of debt, you say this 142. Okay, the denominator does not change. What do you get? Hello, what are we finding?
I found 0.2217.
0.2217. So you can leave it as 0.22, right? As this one, which is in blue now, as the weight, the market weight of debt. So now we have almost everything that we want. We have everything that we want. We have the cost of equity. You have the market weight of equity. You have the cost of debt after tax. We also have the market weight of debt. Then we can just write. You can just start, madam.
The one we are just from calculating where you found the same one you are deleting. What were we finding there?
We were finding the market weight of equity. This one, it was this one. The value of equity divided by the value of equity, you know, plus the value of debt anyways. The value of debt that we found. That's what we are trying to find. We are trying to find this part, okay, in short, this part. This one, yes, thank you. All right, so from there, let's start writing. Very easy now from here. What is the cost of equity? It said is 0.1515. That's what the question says. Then the weight, the market weight of equity is what? Is 0.78, right? Plus the market weight, the cost of debt after tax, it is given as 0.0774 as you gave me. That's what you gave me, remember. Then 0. What? Multiplied by 0.22, which is this other part. The value of the market value of debt, actually. That's the market value of debt. So we can now multiply. Multiply those and then we get better. What do we find as the WACC? The weighted average cost of capital. You can start with this one. $0.117, right? Plus 0.074 multiplied by 0.22. We close. We find the 0.01628. and we add 0.117 so that it can be 0.13328. If you multiply by 100, you find 13.3%. 13.3%. Are we all finding the same?
Yes.
Yeah.
So is there a question? Do I have any question on the weight of capital? On the weighted average cost of capital WACC? People don't have a question, but sir, they have understood.